Iron Financial, the explainer where we dive deep into the balance sheets, break down the structural integrity of the market's biggest players, and help you forge a stronger portfolio. I'm your lead analyst, and today we are cutting straight through the market weakness to look at a heavy industry giant that is currently testing the absolute limits of its own durability. We're talking about the Greenbrier Companies, ticker symbol GBX. We are looking at their Q3 FY2026 earnings report today, and honestly, with a massive economic uncertainty swirling right now, this report is the ultimate stress test. If you're looking to build a portfolio with a rock-solid foundation, you're going to want to hit that subscribe button right out of the gate. And I'm the market skeptic. I'm here to ask the hard questions that you're all thinking at home. Is this company actually building a solid foundation, or are they just meticulously masking the cracks in their armor? We are staring down some major macro headwinds right now, folks. Sticky inflation, the cost of capital sitting at multi-year highs, and a very real, measurable slowing of freight rail traffic. We absolutely need to know if this latest earnings report is just a temporary speed bump on the tracks or a flashing red warning sign of something a whole lot worse. So, let's get right into it. Right up front, this really is the multi-million-dollar question we have to answer. Is GBX a classic value play? Meaning, is it a fundamentally sound industrial powerhouse that's just temporarily trading at a steep market discount? Or is it a value trap heading completely off the tracks? When we analyze the broader macroeconomic pressures, you realize the sheer amount of heavy lifting required to maintain a massive manufacturing and leasing footprint in today's high-rate environment. It's frankly staggering. Is the economic weight simply getting too heavy for them to handle? That's exactly what we are going to deconstruct today. Look, Greenbrier is a massive railcar manufacturer and leasing management company. They have a massive global footprint, and their operational performance is deeply inherently tied to the health of the industrial sector, the global movement of commodities, and frankly, capital availability. So to answer your question, we absolutely cannot just look at the service-level stock price. We have to drill down into the absolute bedrock of their Q3 FY2026 financials. We're going to separate the daily market noise from the raw, undeniable numbers. Section 1, top and bottom line erosion. Let's look for those cracks in the armor. Cracks in the armor is a massive understatement. When I read through the 10Q and the 8K filings for this quarter, the top-line erosion looked a lot less like a surface crack and way more like a complete structural failure. Well, let's lay out the year-over-year massacre for everyone so we're all on the same page. Q3 FY2026 revenue came in at $576.5 million. Now compare that to the $842.7 million they printed in the exact same quarter last year, and you are staring at a brutal 31.6% revenue bleed. And the bottom line is arguably even worse. Net income attributable to Greenbrier completely collapsed. They went from $60.1 million in Q3 of last year down to just $18.9 million this quarter. Guys, that is a 68.6% freefall. You just can't brush off a nearly 70% drop in net income as some kind of normal seasonal fluctuation. That massive of a drop tells me the core engine of this entire business is stalling out. I don't disagree that the year-over-year drop is incredibly harsh, but as an analyst, I have to look at the sequential data too, not just the annual comparisons. If you look closely at Q2 FY2026, which was just one quarter ago, their net income was actually lower, sitting at $15.0 million. So while the annual comparisons look like an absolute derailment, sequentially, quarter over quarter, they actually ground at a slight improvement. EBITDA reached $69.1 million, which is roughly 12% of revenue. It shows they are actively finding operational efficiencies and tightening the belt even as that top line shrinks. Efficiencies are great for the boardroom, sure, but let's talk about what the shareholders actually take home. The diluted earnings per share for this quarter came in at just $60.00. Correct. Last year, in Q3, that exact same number was $1.86. We are talking about a 67.7% plunge in diluted EPS. When your earnings per share gets violently shaved down to a third of what it was just 12 short months ago, you have to ask point blank, do these derailed profits indicate the start of a structural collapse? Are they completely losing their pricing power in the broader market? Because that's what it looks like from the outside. It's a highly valid concern for sure, but to actually uncover why that EPS tanks so hard, we can't just stop at the top line. We have to tear apart the income statement. We need to look at their specific operating segments because they are actually telling two completely different stories right now. Section 2. Segment divergence. Heavy lifting versus financial stabilizers. We really need to find out where the structural weaknesses and strengths actually lie within Greenbrier's overall business model. We're going to compare their core manufacturing segment directly against their leasing and fleet management segment. On one hand, you have the heavy welders working raw steel, This represents the core manufacturing floor where raw metal physically becomes a working railcar. This segment took a massive, undeniable hit this quarter. But contrast that with the finished, branded railcars out operating in the field. Those represent the leasing and fleet management division. While the manufacturing side took a severe beating, the leasing segment actually stepped in and acted as the company's ultimate financial shock absorber. Shock absorber or not, you are still fundamentally a heavy manufacturing company at your core. If the factory floor is bleeding out, the whole building is at risk of going under. We need to look at exactly how bad that manufacturing contraction actually was. So the 10Q filing notes that manufacturing deliveries plunged by roughly 33% to 39%. That sharp contraction in sheer physical volume drove the massive revenue decline we were just talking about. But what really concerns me is the product mix shift. They clearly had fewer new premium railcar orders coming through the door. This means they're being forced to build railcar types that simply don't command the same premium pricing, probably just to keep the lights on and the factory running. That dynamic, combined with less volume to absorb their massive fixed costs, squeezed their manufacturing margin by 5 to 6 full percentage points. That is a massive, heavy drag on the overall financial structure. You cannot forge a strong portfolio if your core asset is actively losing its profitability. You're absolutely right that the volume drop is severe. Fewer deliveries mean less revenue absorption for their massive fixed factory overhead. But here is where we need to look at the numbers like seasoned traders, and not just panic at the first sign of blood. Despite the sheer drop in volume, Greenbrier actually managed to improve their overall aggregate gross margin sequentially. It rose to 14.1% this quarter, up from 11.8% in Q2. So the question is, how did they actually do that if manufacturing was struggling so badly? They pulled it off because of a very stark internal contrast. Yes, the manufacturing gross margin was squeezed down to just 9.9% on $529.1 million in revenue. That is a huge top-line number generating very little actual operating profit. But look over at the leasing and fleet management side of the house. They pulled in $47.4 million in revenue, but they did it with a booming 60.3% gross margin. Okay, I'll admit, a 60% margin is incredible for an industrial stock. I'll definitely give them that. Exactly. And it's not just the margin percentage, it's the sheer scale of the operation we're talking about here. They expanded their owned lease fleet by 23% sequentially. They now own 20,600 units. To put that into perspective for everyone, if you linked those 20,600 railcars end-to-end, you're talking about a continuous train over 200 miles long. And the utilization rate on that massive fleet is a staggering 99%. That means almost every single car they own is out there on the tracks generating cash month after month. It is high-margin, recurring revenue that acts as a fortress wall against the brutal cyclical swings of pure manufacturing. Section 3, Debt Stack and Liquidity. Let's talk about how they are actually financing this massive fleet. Okay, I hear you loud and clear on the recurring revenue argument, but you don't just magically expand an owned fleet by 23% in a single quarter without spending a literal mountain of cash. Buying and holding over 20,000 railcars requires immense, heavy capital. I demand a look under the hood at the balance sheet, because in today's high-rate environment, is this debt load just too heavy for Greenbrier to carry? If they over-leverage themselves to build out this fleet, the interest payments alone could absolutely crush them. Let's deconstruct the leverage stock then. Yes, as of May 31, 2026, Greenbrier had total consolidated debt of about $1.8 billion. That sounds scary, but the divide between recourse and non-recourse debt is the absolute key to understanding their structural safety. $1.07 billion of that debt is non-recourse, tied directly to the lease fleet. Only $733.3 million is recourse corporate debt. You need to explain the difference for the audience, because to most people, $1 billion in debt is still $1 billion they have to pay back. Fair enough. Non-recourse debt means the loan is secured solely by the assets themselves, in the specific case, the actual railcars. If something goes catastrophically wrong, the lenders can come in and take the railcars, but they cannot legally come after Greenbrier's corporate parent for the rest of the money. This quarter, Greenbrier strategically took on a new $425 million non-recourse term loan specifically to fund the growth of this lease fleet. It's incredibly smart financial engineering. They are isolating the risk of the fleet expansion completely away from the core corporate structure. Smart engineering? Maybe, but you can't engineer your way out of a massive cash burn. I'm pushing back hard on the liquidity front right now. Let's look at the cash reserves drop-off. In the prior quarter, they were sitting on a very comfortable $521.8 million in cash. In Q3, that number dwindled all the way down to $273.7 million. They burned through roughly $250 million in a matter of months. Does this cash burn expose severe cracks in the foundation? Are they spending way too much trying to pivot into leasing while their core manufacturing business dies on the vine? It's not a blind burn, though. It's a highly deliberate capital allocation strategy. Let's look at their guided $380 million in gross capital expenditures for the entire year. $300 million of that capex is targeted directly at leasing and fleet management. They're actively deploying their cash to build that 60% margin recurring revenue engine we just talked about. They're strategically trading short-term liquidity on the balance sheet for a permanent, high-margin asset base. It's an investment in long-term durability, not just reckless spending. Section 4. Backlog, buffer versus trimmed guidance. Let's look at what's coming ahead. To really talk about durability and future visibility, we need to steer this debate toward what actually comes next. The market is forward-looking, always. So we have to contrast management's updated, lowered expectations for the rest of fiscal 2026 against the raw, brute strength of the company's massive, multi-year production pipeline. Well, let's start with the bad news, because management themselves are openly admitting the macro pressures are overwhelming the business. Look at this trimmed FY2026 guidance. They proactively reduced their full-year profitability outlook across the board. Aggregate gross margin was previously expected to hit up to 15.2%. Now they've lowered that ceiling to a maximum of 14.2%. Operating margin is trimmed down to a ceiling of 6.8%. Listen, when your operating margin is trimmed down to 6.8%, that leaves almost zero room for error in heavy manufacturing when volume drops. One supply chain hiccup and you're in the red. And the EPS? The EPS guidance is the real kicker here. They previously guided for up to $3.50 per share. Now, they've shaved the top end down to a tight $3 to $3.15 range. When management pulls down their own earnings ceiling by 35 cents right in the middle of the year, it proves they see dark clouds ahead. The heavy industry cycle is turning aggressively against them, and they know it. I definitely see the guidance cut, but I have to fire back with the ultimate backlog buffer. Greenbrier is currently sitting on a 13,800 unit backlog valued at a staggering $2.0 billion, and that production pipeline extends all the way through 2028. Furthermore, even in this fundamentally weak Q3 environment we've been detailing, they still managed to book 2,200 new railcar orders valued at $340 million. Yeah, but they delivered 3,600 units in that exact same quarter. Their book-to-bill ratio is under 1. That means they are building and shipping cars faster than they are selling new ones. You cannot survive on a backlog forever if you aren't replenishing it. True, the book-to-bill is undeniably soft right now, but a $2.0 billion backlog provides a massive, solid foundation of guaranteed work. It gives them years of runway to navigate this current market weakness, optimize their factory floor efficiencies, and continue feeding newly built units directly into their own high-margin leasing fleet. It buys them the most valuable asset in finance, time. Section 5. The verdict. Let's talk about forging your portfolio. We've drilled down through the top-line erosion, the margin squeeze, the massive pivot into leasing, the incredibly smart debt stack, and the billion-dollar backlog. It is time to deliver our final no-nonsense summaries. Our ultimate goal at Iron Financial is to help you make sense of these conflicting data points so you can actually forge your portfolio with real confidence. So here is the bull case. I see GBX as a cyclically depressed, high-yield opportunity right now. Yes, manufacturing revenues are down 30+%, that hurts. But they are actively using this down cycle to ruthlessly expand their leasing segment, which operates at a 60% gross margin with 99% utilization. They have a $2 billion backlog extending into 2028. And their debt is strategically isolated as non-recourse. And perhaps most importantly for the income investors out there, they have a fortress-like history of returning capital to shareholders. The board just approved their 49th consecutive quarterly dividend at $0.34 per share. Let that sink in. That means through rate hikes, supply chain crises, global pandemics, and volume drops, they've structurally maintained their payout for over a decade. In my eyes, you're getting paid a solid yield to wait out the cycle, while management builds a much more resilient, recurring revenue business in the background. I'll say this, it is definitely not a black and white earnings report. There is serious structural damage on one side of the house and some really impressive financial fortification on the other. But here's the bear case, the final provocative thought I want to leave you all with today. You can have all the recurring revenue you want, but if your core manufacturing engine sees a 68% drop in net income and your EPS violently plunges from $1.86 to $0.60, you are bleeding. The cash dropped by nearly $250 million in just one quarter, and management themselves just shaved their full-year guidance down to a tight $3.15 ceiling. As macro headwinds like sticky inflation, high interest rates, and slowing industrial demand continue to intensify, does this massive top-line erosion ultimately make this heavy industry play a classic value trap heading straight off the tracks? That's the data, straight from the filings, forged for your understanding. The choice on exactly how to play it is yours. Thanks for joining us on this explainer. Keep your stops tight, do your own heavy lifting in the research, and we'll see you on the next deep dive right here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.